Welcome to Beat the Markets.
I'm Richter.
And I'm BKM. So on the last episode we had a guest and it worked out pretty well, I thought. So we brought in another one, Brad, who I think we met back in, I think it's about 10 years now.
I think so.
During the financial crisis when you were rummaging around tax yield.
Right.
Now we'll, tax liens.
Right.
We'll save what those are for another show.
Okay.
But one of the things that we've discussed over the years, which has been kind of a fascinating topic for us at least, is retirement.
Right.
Now,
that's where we're all headed. Right?
Now, it may not seem fascinating, but there's a fascinating aspect of it. So why don't you tell us a little bit about what our discussions were about over the years?
Yeah, well, I think the primary aspect that we had discussed, lots of branchings off, but the main theme was the idea that there's actually quite a bit of difference between saving for retirement and then once you retire, taking your savings and turning them into retirement income. And that was sort of the underlying framework for a lot of the things we had talked about in that area.
Now, in that realm, this is only a thing that I've been kind of realized it was important relatively later in life, because when you're younger, right. I was like,
yeah, you don't think about this.
You know, I remember when I was younger, my dad told me to open up an IRA. Whenever you have an earned income, you open up the IRA because you get the tax benefit, and
right.
and he's like, just whatever you earn, put in the IRA. I'll give you the money that you're losing because you're putting into the IRA. Right. So I tell my friends the same thing.
Is that deal still available?
He said once you graduate college, you're off the payroll.
Oh,
okay. So I would tell my friends the same thing, and they'd be like look at me like I'm from Mars talking about retirement when I'm like 20-something years old.
Right.
But now that I'm 40 and this discussion is starting to come into play, people are starting to think about retirement. And what I find fascinating about where we're going to go and take this discussion is that there's a lot of stuff about how to build up your nest egg. Now, some advice is better than others, and
right.
we have a point of view from the market's perspective of how to do things better. But there's a lot of literature out there, and the whole industry is geared towards accumulation of assets, right. Or what they call the accumulation phase.
Sure.
But there isn't a lot of discussion about what to do once you have that accumulated assets and how to navigate the retirement phase itself.
It's a lot more complicated.
So why is it more complicated?
Well, I think one way that I like to look at this is, let's say I was an engineer and I'm looking at an investment portfolio for somebody who hasn't retired yet versus an investment portfolio for somebody who has retired. And if we ask, so engineers look at something and say, well, okay, what is the problem we're trying to solve, or what is the job we're trying to do, right? So if an engineer looks at the portfolio for somebody who hasn't retired yet and they say, well, what's the job here? Well, the job is just to go get bigger. That's it.
Right.
I won't say that's easy, but it's simple.
The objective is clear.
Yeah, it's a fairly linear problem. I call it a gravel pile problem. If there's a pile of gravel sitting right there and somebody says, well, the gravel needs to be over there, and there's a shovel and a wheelbarrow, it may not be easy to get the gravel over there, but you don't have to spend a whole lot of time thinking about what to do, right? There's no mystery, there's no analysis to do. You just pick up the shovel and start going. Okay, well, so you ask that question for somebody post-retirement. Well, now all of a sudden it's very complicated, because income doesn't just mean what your portfolio earns, right? You've got that, you've got Social Security, maybe you've got a pension. And so you've got all these things that you could put on a list of, well, these are the things that add assets to the picture. But then there's another list, and it's actually a bigger list on the other side that says these are the potential things where resources could leave the equation. And when you start getting into how many different moving parts there are and how they fit together, it becomes evident very quickly, okay, this is a whole different kind of problem than just get bigger.
Okay, now to follow up with that, does the problem go away if that pile is very big?
Yeah, it goes away if it's very big, but very big means $5 million, $8 million, $10 million probably. I don't know exactly where the break point is because we don't know exactly how old the person is. We don't know what their rate of return is going to be. We don't know how much they're pulling out each year. So it's, if you fill in the blank on all those, then we can solve for, well, this is how much money you got to have. But speaking in just general terms, it's hard to say. But yeah, there is a point where the capital can be large enough that what we could call the brute force approach to financial planning works, which is I have so much money and when a bill comes, I'll just cash something and I'll pay for it and I don't need to worry about the details. Not very many people as a percentage of the population are going to be in that position.
Right. So that kind of explains a little, I guess clarifies what the problem is, but most people aren't ever going to be in that situation. They're going to be, so whatever's left. So let's say that you have X amount of money.
Right.
Now, and that X amount of money is in what form? It
could be in anything. I mean, $1 million is a popular number to use.
Okay, so let's start with $1 million.
Yeah, let's say you're 65 years old, you got $1 million, and you're going to need to pull out $50,000 a year. Okay. So, on just so $50,000 a year, if there were no returns, that's 20 years, right? Except it isn't because of inflation, right? So if there were zero returns, that $1 million at $50,000 a year would not last 20 years,
right? Because
of inflation. Okay, so now we got to start adding some returns in there, and depending on what return level we select, then we will, the number of years is going to go up. But what you're going to find is the basic idea that most people have is I'm going to save some money and then I'm going to live off the interest.
That's the hope.
That's the hope. But the reality is that most people are going to be in a situation where they save some money, they earn some interest, the interest funds some or maybe even all of their income need initially. But down the stretch, usually one of two things happens. Either A, just by force of inflation, the whatever they're earning is no longer enough just to cover the income. The other thing that could happen is some sort of unexpected expense, probably medically related, that causes them to have to go in and get more than what they had allocated for that year. And as soon as that happens, it completely changes the depletion curve going out into the future. So, we could stop right there and we can already recognize, okay, yeah, this is more complicated than just building up money. But if we were going to do a complete job of talking about that, we would have to start adding in things like the difference in taxation between IRA money and non-IRA money. Or if it's not in an IRA, is it a capital gain or is it in real estate where you're getting some sort of a depreciation? You got a lot of tax arbitrage potential running around in there. You got the potential that, everybody invests because they want to end up with more money out here than they did back here. But sometimes investments don't go that way, right?
Right.
So there's the possibility of losses, whether they're temporary or whether they're permanent, whole other chapter. What if somebody in your family needs money? So there are all these things that you have to look at. The way I always describe this is if you're going to do retirement income planning as well as it can be done, you got to look at all these things. And all of these things ends up being a list of about 14 or 15, high level, these things add resources, these things take resources away, and how do all those pieces interact. And as you said, that's just not something that your standard, retail broker, or honestly, it's not something that most RIAs or anybody like that is even talking about because it's very complicated. It's very hard to roll out on a general basis too. It's you could have 3 different people and have 3 very different answers for how to solve for X because they're going to have different things, different ages, different health, all the rest of it.
So one of the
Other
things.
than that, it's very easy though. Yeah.
So one of the things that we talked about before we started filming was about, I really liked about it, and I'd like you to share it with, is the difference between being wrong and incorrect.
Okay. Yeah.
And then we can apply it for how we look at the retirement problem.
Okay. All right. So to kind of get a running start on that, so I'm a CPA. I spent a couple of years doing traditional stuff. I shifted over into more of the consulting side of things, and I left public accounting because I wanted to be a management consultant. And I ended up becoming an investments guy, and again, that's a whole other story. But one of the things that I started noticing very early in my career as a consultant, I started trying to study why people were wrong about things. I started looking at decision-making processes. I started trying to understand, well, when somebody does something that's wrong, why does that happen? And so this idea of being wrong without being incorrect, or being incorrect without being wrong, I don't remember how I said it. But the basic gist is this. Somebody comes to you and says, we've analyzed number one, we've analyzed number two, we've analyzed number three. And as a result of that, we think we need to turn left. And you say, yep, based on 1, 2, and 3, I think you should turn left too. And they say, so turn left. And you say, no, actually, this is a right turn. And they say, well, how can it be a right turn? You say, well, because of 4 and 5. And so what I mean is that their analysis of 1, you can't find any flaw in the logic. Their analysis of 2, you can't find any flaw in the logic. 3, the problem is they didn't analyze all the pieces.
They're unknown unknowns.
Unknown unknowns. Or to put it back into accounting terms, one of the primary things that makes accounting work is something that's known as the assertion of completeness. If we know we got all the transactions, we know the ledger is right. If we know the ledger is right, the financial statements can be right. But if we don't have all the transactions, nothing downstream of that can be right. And the same thing holds for this decision-making process. If there are 5 important variables to consider in the analysis and you only consider 3 of them, it doesn't matter how good a job you do of 1 through 3. You still maybe don't get, I mean, you may get the answer right, but you got it right because you lucked into it, right? Not
right.
Because you solved the math problem and got all the points and
right.
Your math teacher didn't put red X's all over your paper.
So now let's bring this forward to the retirement problem.
Yeah.
So my question is this. Number 1 is, are all the known, are there unknown unknowns, or do we know all the factors?
I think we can say we know what all of the major factors are. Or maybe a better way to put that would be is we know what the major factors are going to be in the majority of cases.
Okay. What are the factors?
Okay. Well, like I said, if you're looking at the side of the list that deals with expenses or things that could take resources away, I think there's about 8 of them. I'll try to remember them. One is just your normal monthly household budget. Number 2 would be budget items that are not going to be repetitive. And what I mean by that is we're going to go to Italy for 3 months, or we got to finish paying for the granddaughter's education, or whatever. So you're planning for
the one-time charge.
Yeah, they're one time, or they're going to be with you for 3 years or 5 years or whatever.
Fix the roof.
Yeah, fix the roof, something like that. So let's see. That would be two things. You got an entire category of things that are going to hit on the healthcare front, right?
But that's unknown, sort of.
Well,
right?
we know where we're going to find. It's like
we know it's
if we're like, think of this as like we're setting up file folders for where the invoices are going to go when they come in.
Okay.
Right? We know we've got some household budget stuff every month. We know we got some one-time stuff we're planning for. We don't know what the healthcare stuff is going to be, but we know it's coming. We don't know what the tax bill is going to be, but we know it's coming. We don't know whether or not our assets are going to earn what we hope they will, but we're going to find out. And even though that may not be an expense in the form of write a check, if you thought you were going to earn 7% and you earn 4%, then that takes resources away.
It comes from capital principle.
Yeah, it takes resources away in an economic sense, because what you thought you were going to have to work with, you didn't have to work with. So let's see, what else? The force of inflation is going to take away resources. So that's what, 5 or 6. I'm losing count here. And whether or not your family is going to end up needing money. And family needing money actually is a more complex topic than just, I need to give you a check. Because a lot of times, not a lot of times, but it's not unusual to hear somebody who is in their 50s or maybe early 60s who has a parent that's in their 80s. Parent needs care, and the person in the 50s or 60s says, well, I'm going to go ahead and just retire early so I can take care of mom.
I've heard that a lot,
right?
Yeah.
Well, that ends up being very expensive. A, because earned income that was going to come isn't coming. B, if you tap into your 401k or whatever, not only are you now creating more years of income than it has to cover, you're also taking away years that it could have been compounding, right?
Right.
So you've got this real deal with the devil going on, and a lot of people walk right into that one, and what they do is they say, well, gosh, home health care is going to cost this much. And I know that the price tag is this, so I'm just going to do it myself. The problem is they don't take into account, I mean, it's back to the same problem. You don't account for all the actual costs associated with doing that. So like I said, just the fact that you are connected financially to your family is, now that's over on the other side too. You might get an inheritance, right? Well, I mean, you might.
Right.
So, or you might be the recipient of that care as the retired 80-year-old, right? So the family part is a two-sided coin.
Right. That's a good point.
It's on both lists, but yeah. So I mean, all of these are all the major categories, right? Now that's not to say that something might happen that doesn't fit in one of those file folders when the invoices come in. So maybe we need one for other. But we would expect in the typical case 80, 90, maybe even 95% of what actually plays out. Again, keep in mind we're talking about plays out over the course of 20 or 30 years, right?
Right.
This is not a one-year exercise.
Right.
But what plays out over that period of time is going to go, most of it, in one of those 7 or 8 file folders.
Okay, so now, one of the things which I really like talking with you and discussing these things is because you approach a lot of these issues, for lack of a word, logically or systematically, and it seems very logical when you lay it out.
Right.
Now, so this might be coming a little bit of a left field, but humor me, okay? So one of the things I find with when you plan it this way, I have $1 million and I need to get $50,000 a year, and you're gonna work with those permutations as best as you can.
Right.
Now, everyone's comes from their own background understanding, but my background understanding is very few people would, I guess, content themselves to living in that $50,000 a year scenario, because within a lot of people, it's still that dream to make the $1 million into something larger. And you're retiring, and this is your time on, I guess, for your time on Earth, and you want to make the most of it, and you still have your dream. You still have your dreams.
If you're going to do it, now's the time to do it, right?
Yeah. So there's this human aspect. This is based off a discussion we had a few years ago, and I remember it. I don't know if you remember it, but it was interesting. You're talking about where you wanted to. You're building your business up, and what you're really interested in. You're really interested in this helping people plan out their retirement and giving this retirement advice, and you were kind of let the other business go on autopilot and move on into this world.
Right.
And I forget where it was going, what the details of that, but basically I said, you're going to leave your business or let it go on autopilot. And you're like, yeah, I mean, how much money does a human need?
Right.
And I mean, it's a very logical thing to say. It's a very not a common thing to say, though.
Yeah, and in practice, it's hard to get your head around. I mean, look, so again, I'll put my engineer's hat back on. Engineers talk in terms of a thing called overage. You know what overage is?
No.
All right, so overage is we got to pick up this thing, and this thing weighs 2,000 pounds. Are we going to buy a 1-ton jack, or are we going to buy a 2-ton jack?
Okay.
We're going to buy a 5-ton jack, probably, right? That's overage. Okay, so if I really think I need $2 million, is there an argument to be made that I should be trying to make $4 million? Yeah, there's that argument. But the place that I think this maybe has more value is if you flip the equation around, it's not in the cases where somebody could make more. It's not in the cases where they're going to have plenty. It's in the cases where somebody wants to live at a certain level and they're asking the question, do I even have enough to get to that? Right?
Ooh, well, that's a good question, because
Yeah.
I gave you a client of ours to talk to, because
Right.
a lot of the question is, this is what I got, and
How far will it go?
well, that's even that's a good question. The question is, this is what I got.
Uh-huh.
This is my standard of living.
Mm-hmm.
Make it work.
Right. Which,
And that gets into, I think a lot of the questions people ask in retirement is just which is they don't get into all these variables that you talk about, which is super critical.
Right.
And it's one of the things that we talked about in one of the past episodes, which is that, what are you going to do if you don't get these returns? And you gave I thought it was funny, but you gave the very appropriate answer, which is like, get a second job and cut your costs. Don't go to Europe. Go to the Tennessee, cabins for your vacation. And that's a very logical answer, and it's probably the best honest answer. But it's a hard thing
one to swallow. I mean,
because people don't want to hear. Don't want to hear.
Okay,
that.
so first of all, let me say this: there is a school of thought in financial planning that says if something is tied to an emotional response, the correct way to deal with that is just don't be emotional. That's preposterous. Human beings are emotional, full stop. And they are most emotional about the things that mean the most to them, which means if you think that their money and how they're going to take care of their family is the thing on which they're just going to be able to switch it off.
Good point.
I would say you haven't sat across the table from a whole lot of people and said, I'm sorry. But anyway, so this emotional thing, or whatever you want to call it, when somebody comes into the office of a financial planner for the first time to talk about retirement income or whatever, in the back of their mind they have a question. And that question is, am I going to have enough money to live on? They might not ask that question. They may act like they think they've done a really good job. They may take great pride in showing you everything they've accumulated. They may even take great pride in how well they have organized it in the folder. I've heard comedians say people walk up to them all the time and tell them jokes, obviously hoping that the comedians can say, man, you're a really funny guy. Okay, so the accountant version of that is people come in and they have their presentation or they have their financial reporting, and I guess what they want me to say is, wow, you've done a really good job of laying out those financial stuff.
People like those A+.
Yeah. All right, so I'm joking a little bit, but the background question behind all of that, and the thing that if you could get them in a moment of honesty and say, tell me the one thing you want to know by the end of this meeting, if you're on that side of the table, you want me to have said to you, yeah, based on what's going on here, absent any unknowns, you ought to be all right. Thanks. That's what they want to hear.
Yeah.
But if that's not the right answer, you can't say, I think you're going to be all right.
Yeah.
And so now, yeah, you're right. So you go back to, okay, well, you've either got to increase the inputs or you got to decrease the, not outputs, but the outflows.
I've had that discussion with clients, and
it's not fun.
They don't want to hear it.
Yeah.
People who have enough assets to live quite comfortably by global standards of living, by American standards of living, but it's just a bit above. It's maybe 50% above where they've been living. Mm-hmm. And there's just no responsible way for them to keep it up. To try to shoot for the kinds of returns that it would take
right.
to maintain that standard of living would be dicey. Because there's nothing worse in retirement than a deep drawdown in your investment portfolio.
Yeah.
And so the only option there is so you have to be prudent with your investments no matter what. Mm-hmm. You whatever strategy you take with those investments, it has to be one that has a very small possibility of a loss of say 30% or more. That has to be a near impossibility, as close to an impossibility as you can reasonably make it.
Yeah, I think so.
So when you cut out, just buying and holding the NASDAQ because it's been going up, you take away that blue sky. That people want to think that their investments are going to save them because there's no limit to how high it can go.
Right.
But no, I mean, realistically, in today's investment environment for a retiree, you're being irresponsible if you're invested in the expectation of anything greater than, I don't know, call it 7%, and you've got to really be savvy to get 7% intelligently in today's environment.
Yeah, and to clarify something you just said, 7% means a global 7% on everything.
Yes.
That's what you're saying.
Yes.
And that is something that a lot of people don't get. They say, well, I'm invested in this and I'm making 7%. It's like, yeah, but all this other stuff over here, what about the $25,000 or $30,000 in cash that you got sitting in the bank so that if some unexpected thing happens, you don't have to call your broker while you're in the middle of a stroke and say, sell XYZ.
Mm-hmm.
That's not earning anything, right? So we got to factor that in. And so now all of a sudden you start getting into those things, or, well, I've got this $50,000 CD that my Aunt Lucy left me. Well, that's not earning 7%. And we all know the way our averages work. So if part of the average picture is those lower things to get to the 7% you're talking about, the other things have got to be even higher. So yeah, I agree with you. 7%, a global 7% is
that's unreasonable for anybody.
Yeah,
for anybody
it's
except
be
for
tough.
Guys who do.
It's going to be tough.
Asset allocation.
So this gets into the point where we have a different approach to the problem.
Right.
So Rick and I have a preference for the liquid markets because you can put everything, you can have all your global assets
right.
in a liquid strategy that's risk managed, and it's liquid. So if you need the money,
right,
you can access it, or you can even take a little bit of from what's SMA stand for, brokerage account, but you can take it out of
special memorandum account.
You can take it a little capital out of there if you need it on, right on the.
If you have a margin account.
If you have a margin account.
Yeah.
But it's liquid enough where you can get out of this stuff in and out. In 15 minutes for most people.
Yeah, you can.
So.
And if it's in multiple asset classes, I think that I don't. There is nothing inherent to that makes it a bad idea. The place that people run into trouble when they have money in things that you said liquid markets. I like the term exchange traded markets.
But okay.
The thing about an exchange traded market, and it doesn't matter what the underlying asset is. We could be talking about oil. We could be talking about Indian stocks. We could be talking about the biotech sector. If it trades on an exchange, it can go up fast, but it can come down fast too. And so the problem that you run into out there in the world is that you've got a retiree who is in exchange traded markets, except it's not exchange traded markets, it's one exchange traded market called the US stock market. And so then it goes down and they need some cash, and so the only place they have to go get it is from the depressed asset, which makes that loss permanent.
Yeah.
The worst thing that can happen is it's drawdown early in retirement.
Yeah. Well, but I mean, really, yeah, you're right. But if you phrase it that way, it almost implies that there's like a good time for there to be a drawdown during retirement.
If you had retired in, say, 1982, and the stock market did nothing, the stock market did nothing but go up for 18 years.
Right.
And then it went down when you were, 90 years old. That money compounded so much that even if it fell by half, you were fine. Whereas if you'd retired...
Well, you were fine as long as at 90 you hadn't reset your expectations based on... But what I'm getting at is, okay, let's say you've got... I think you guys are talking about like a diversified, global, several different actual markets. Okay, fine.
Yeah, asset classes.
Asset classes. So let's say, you've got 1, 2, 3, 4, and 5, and 3 just happens to be the U.S. stock market. The U.S. stock market goes down and you need money, well, you just leave that allocation alone. And you take it out of one of the others that hasn't, depressed, and then if the stock market needs to, come back up and make up the losses, well, fine, you got time. But you can't do that if all the money is in the stock market.
Right. So I mean, one thing is, I think we all know the solution isn't to have 100% of your money in the stock market. And even conventional wisdom that won't say that. They do the 100 minus your age is your stock market
you're
allocation.
Right. Conventional wisdom says that, but
what people actually do.
Yeah.
And the thing about it is because of this demand, because the sentiment of the times, people's need for higher return, your average advisor is increasing that stock allocation just to get that extra return. They're almost like using it like it's like a menu. Like, Mr. Ricker, what kind of return would you like in retirement?
Right.
And then they say, oh, you'd like 8%? Well, then we need to have you 80% in stocks.
Right.
And the market doesn't work like that. So we have we've approached it with the market solution, but like you said, the market or exchange traded there's this mark to market and that value fluctuates, and we feel there's a way to manage that risk, and what you're giving up with those with that market, you're getting compensated in another way. But you've approached it, what I said was an alternative, correct me if I'm wrong, but an alternative solution, and I'd say you look at how to solve the problem through private equity, real estate, and insurance products, which
essentially my premise is, if you want to use stuff that's in an exchange traded market and you know what you're getting into, fine, go ahead and do it. But if the question on the table, is it possible to have a well-diversified portfolio and not use any exchange traded assets in retirement? The answer is yeah, it is possible. So I feel like a lot of people invest in stocks for a lot of reasons, but one of the reasons is because they don't feel like there's anything else out there. And that's not, the data doesn't back that up. But to go back to something you were talking about a minute ago, you're right, brokers are putting people in that stuff, but think about this. Even if there aren't any new investments going into stock accounts, if you look at what the concentration is today for the typical person versus what it would have been 3 years ago, just by action of the stock market, they've got a higher concentration in stocks because they probably haven't rebalanced anything.
Right.
So this problem on paper, getting rid of overconcentration is a priority in portfolio management. In practice, you've got people thinking, well, stocks are really about the only thing. You've got brokers who are saying, well, this is the simplest thing to put it in. And you've got a rising stock market, which means that even if you don't do anything, your concentrations are going up because that's outrunning whatever your other valuation is. And that's where a lot of people are right now.
So one thing that I like about the idea of having nothing in exchange traded products is that people are their own worst enemies. That seeing that quote, seeing that fluctuation, and having the ability to just click sell is just the bane of your investing life.
Right.
Your average retail investor who does it themselves, doesn't go through an advisor, has such a lag, pays such a tax in bad market timing that he'd be better off in a savings account.
Probably would.
No, yeah, I've seen the data on this.
Yeah.
Actually, the people who do best at Fidelity are those who've either died or forgotten they had accounts.
Right. That's pretty good.
So if you're going to lock it up, in rental real estate that you can't sell, in a stack of Krugerrands in your basement, and maybe private investments in a private cash generating business, as long as it's not a speculative like startup business, then that's a good solution.
Yeah, and as far as the private equity, well, really all of this stuff, I think that how much money the person has is really the beginning of the conversation as to what's going to be appropriate for asset selection. If somebody has $200,000 and that is their worldly savings, we don't need to be talking about private equity. That's not. Somebody's got $1.2 million. Well, okay. Well, if they want $100,000 of whatever, And like you said,
So how would somebody like that get into private equity? Through like an LP, you mean, or like actually buy directly into a business?
Well, there's a couple of ways that could be done. You know, my definition of private equity is not something in the tech business that is funded by California venture capital money. My definition of private equity is any company that operates that isn't publicly traded. Okay,
Fair
so
enough.
the print shop down the road, and so, you know, I'll try to do this briefly, but there's a two-sided need here. Okay, the guy that owns the print shop, if the print shop is doing well, the print shop should be thought of as part of his portfolio. Okay, that's my starting premise. So if you agree with that, and then we start looking at this issue of concentration, well, probably most of his wealth is tied up in the print shop, or a chunk of it is. He is over concentrated. Well, how's he gonna deal with that? Well, he's got a couple of choices. He can sell the business altogether and then distribute the money, or he can sell a small piece of it.
Yeah.
Not really because he thinks his business is going anywhere, not even because he necessarily needs the money.
Just diversify.
But A, for diversification reasons, or if you really want to make this complicated, some of the theories or some of the approaches that work best for real estate work best if you have a 3 to 5 year period of sort of building things up before you get to the point that you need income off of them. So if I'm 3 to 5 years out from retirement, and I know I'm going to want to have money in real estate when I retire, it's better for me to go ahead and get that clock started now. Where am I going to get the money? Well, maybe I'm going to sell 10% of my equity to this guy over here who could stand a small private equity allocation, but he's not going to go out and start a business. Right?
That's fascinating.
Yeah, so I mean, that doesn't get talked about a lot, and I don't know how often you... Okay, so when I was a little kid, when I was 5, we moved to a different house.
Same neighborhood?
Same town.
Same town.
Yeah.
Okay.
My understanding of the move up until the day that we got there was that we were moving into this house that these other people lived in, and those people were going to move into the house that we lived in now. We're trading houses. Again, I was 5, okay? But my understanding of moving was somehow my parents had found these people who wanted to live in our house. They decided they wanted to live in their house. And it was Saturday, and so the trucks came and we're swapping. Okay? Now, obviously, I later learned, well, no, we moved here, they moved here, they moved here, you know. But what I'm talking about structurally is more like what I thought it was like to switch houses when I was 5. You know, one guy has a business, has an overconcentration, has a need for some liquidity, has a need for diversification, wants to get the clock started on some other asset or some other investment in a different asset class. This guy over here really would like some of that, but doesn't want to go the whole route. Well, you know, maybe they can get together and make a deal.
Yeah, it's a fascinating solution and diversify both, you know, to both clients.
Right.
So if you don't live in a small town and personally know all the business owners, how do you go about finding such a deal?
Well, the way that we've started approaching it, and we're very early in this, but we've got a couple of, so I told you guys beforehand, we've got the side of our business that deals with the kind of stuff that you would think that an advisor would deal with, but because a lot of our clients are real estate investors. And years ago, we came to the conclusion that you can't do real estate investing as well as it can be done if you can't control project management and construction. So we actually have a completely separate side of our business that's devoted to real estate, construction. You know, we've got a fully operating. It's not a side business. It's as big. It's basically 2 sides of the house. So one of the things that we've seen over on the construction side is there's the possibility of construction, just like everything else, has started to use sort of the branding and franchise model. There are franchises of plumbing contractors, and there's franchises of, you know, air conditioning. So an approach would be that. Another would be just to find somebody who is in that. There's another avenue that we're exploring with folks who are career people either in the construction bonding or the property casualty insurance business who have built up a book of customers where they have trailing commissions coming in on insurance coverage.
Sure.
And cashing them out and
buying
yeah,
it.
by the book.
Oh, that's
that's a little more sophisticated. You've got to, if you're going to be involved in that, you've got to have the licensing to do it.
Oh.
But so that's a situation where we're talking to folks who are in that business and they're looking to expand, and we're saying, well, why don't you let us help you try to broker a deal with this guy over here who wants to get out, because if you pay him, then he can go ahead and start investing in whatever else and get his diversification. So that's not like a diversification. That's like a diversification expansion. But I mean, there's variations on the theme. So.
I mean, it's the classic textbook problem, or it's the money now versus money later. And if
it's either money now, money later, or lump sum versus stream.
Right.
If you take those two things and you understand that if you can invest at this and borrow money at this, you should take all they'll give you. Those three things, and you're a finance major. We could do it in 2 hours on Saturday morning and hand you your degree.
Have you looked into these new online investing platforms for real estate, like Peer Street, Roof Stock? So Peer Street does fix and flip lending, hard money lending. They just broker the loan.
Right.
You have loan originators. We know guys who originate loans.
Yeah.
And then, so the originator will take 1%, and Peer Street will take 1%. Mm-hmm. And on a 12% loan, 10% flows through the to the investor. Another way is another one is Roof Stock. That one allows you to actually. So in Peer Street, you buy a fraction of a loan. You could put just $1,000 into a loan.
Right.
But with Roof Stock, you can use debt and buy a rental property. Mm-hmm. You have to own it all yourself. They're not dividing them up.
Right.
But you can put down, say, $40,000 and buy a $100,000 rental property.
Who provides the loan?
They have an arrangement with a bank, or they hook you up with a local bank.
Yeah, over in helping. So the four most common types of transactions that we get into with our clients that do real estate investing. The first is you're buying a house because you want to fix it up and flip it. Okay. The second and third have to do with you're buying rental property. And so one way to buy rental property is to buy it, fix it up, put it in production, or buy it post fix up, already somebody in it ideally. So, generating income on day one. And then the fourth type of transaction is some sort of paper transaction that's backed by real estate. So hard money loan, you can set up, if you don't, the left turn, right turn decision that you have to make if you're going to invest in real estate is, are you going to be the owner of the property completely, or are you going to invest in a pool, right? So if you've got $250,000 that's reasonable for you to put into real estate, and you're going to put some debt on that, you can buy 5 or 6 houses, you have your own diversified portfolio, you're good to go.
What kind of returns are you seeing in a scenario like that?
They're going to vary widely based on where the properties are bought. Mm-hmm. A lot of the work that we do, so our basic premise on real estate investing is you're probably going to hire a professional manager anyway. Mm-hmm. And if you're going to hire a professional manager, then it probably doesn't matter where the property is. There is a perception of, well, I don't live there, so I can't invest there, or I want to be able to see my property. Well, I'm not going to say people who take that approach are wrong, but it's not my opinion, because if I don't have to go over there at 2 a.m. to put in a new hot water heater, I don't care if it's a mile away or 1,000 miles away.
It eats into your return, but if you're doing it yourself, you're working, but
right.
You have to.
You're working to get that extra return.
Exactly.
So anyway, to answer your question, it depends. So a lot of the work that we do is based on, well, we want to look at this neighborhood versus this neighborhood and see which one has the potential for a better rental yield. I was having a conversation with a guy on Monday, and he was saying, well, this is the deal we're doing, and we're still on the fence as to whether or not we're going to flip it and sell it or flip it and rent it. I asked him a couple questions, and he answered them over the course of 30 seconds. I said, yeah, that's not a good rental candidate, because it was going to be a low rental yield.
Typically, I've seen around here at least, that the grungier the property, the lower the purchase price, the higher the gross yield.
Of course. Yeah.
And
And what you run into there is, I haven't answered your question yet on return, and I'm going to loop back to that. But the thing that you run into is there's sort of a barrier on monthly rents. If you're trying to rent a property for $3,000, anybody who can pay $3,000 a month for rent can go get a mortgage. The only reason they're not is because for whatever element of convenience they want to rent. But if that number's $1,000, okay, well, somebody might be able to pay $1,000 a month, but they might not be able to qualify for a mortgage.
Mm-hmm.
And so when you start working through all of that, there's a boundary, both in terms of what the monthly rent is and also what that implies about the size house you're dealing with, that sort of creates a sweet spot. And like a lot of things in life, if you try to make the transaction work outside of that circle, you get what you get. You know,
either no returns in the case of luxury real estate,
Yeah.
or a whole lot of headaches, missed rent.
right.
You know, somebody who moves out all of a sudden and steals your furniture.
Yeah, well, hopefully you're not going to give them the furniture, but yeah, I mean, your point is well made.
Or your appliances.
Well, the horror story is always that your tenant gets mad and pours your drains full of concrete. I don't know that that's ever happened in the history of the world. I know that every time you talk to somebody and they get this look on their face of disgust when you even mention rental property, it's going to end up with them saying, well, yeah, why would I want ticked off tenants that are going to pour my drains full of concrete before they leave? So I don't know. I guess somebody could check Snopes and see if that ever happened. But
I mean, you've done thousands of homes and you've never seen it.
I've never seen it. Yeah, we've been. Yeah, I mean, we've been involved in thousands of transactions. I haven't like seen all the houses, but I don't recall a time that we ever had to replumb a house because there were bags of Quikrete outside when we got there. Anyway, back to your question. Depending on where you are, depending on the value of the house. Like if you're trying to do $125,000 houses versus $750,000 houses. And so let me answer it two ways. If you're doing an all cash deal, it's not unusual to see yields in the 6 to 9% range. And if you're doing...
Is that a gross yield before your management fee?
No, that's net. That's after everything. So you've taken
after
out
property taxes.
You've taken out property
insurance?
taxes. You've taken out insurance. You've paid a manager. You've reserved some money for repairs and maintenance. When it's all said and done, you're six, 7, 8, 9.
Did you say $250,000 house?
Probably. Usually, you see that in houses that are going to be sort of in the 80 to 150 range.
Oh, really?
Now, if somebody is watching this in Boston or New York or Long Beach, California, what you're envisioning as an $80,000 to $150,000 house is not
right.
Somebody
because around here, 120. I've seen 125, and that's Section 8.
Yeah.
So
that's 12%.
So
gross.
just for the viewers, around here is Miami Beach, and where you're doing a lot of your stuff is Alabama.
Everywhere else that's not along the coast.
Right. I forgot how far your money goes when you get out into.
Yeah. If you're in Dalton, Georgia, or Chattanooga, Tennessee, or Lexington, Kentucky, or Fort Wayne, Indiana,
$250,000 is a pretty nice house.
Or Omaha, Nebraska.
Yeah. So these are homes are homes that families live in.
These are 3-2s in the suburbs that were probably built, depending on where you are, in the 70s, 80s, 90s. You know, mom's a school teacher, dad's a cop.
Wow.
Or or maybe dad's a school teacher and mom's a cop.
So good.
I wasn't trying to imply anything there. But I'm just saying, these are just basic, what you would think of as upper middle class neighborhoods that have been there long enough that they have some stability to price. You can buy for $125,000. You can buy that house all day long in more places in the U.S. than you can't.
Wow.
So you lever that, and that's a pretty sweet return.
Yeah. Now, if you leverage it, then it goes up. And honestly, the degree to which you can leverage some of these things, if you know where to go get the right kind of debt, it becomes a number that's so absurd that you don't want me saying it. But let's just say 6 to 9 is not an unusual net rental yield on an all-cash deal. And with leverage, asterisk, leverage carries risk, blah, 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 blah. It can go up from there. I don't ever tell anybody you're gonna earn this, but I would put it in terms of if you told me that you earned, pick a number, I would not be surprised.
So we've been at it for a half hour, so we got to think about wrapping up. But
Sure.
I do have a question about
Sure.
what about the liquidity of the $125,000 home in these?
It isn't.
It is not liquid.
Not really.
Okay, so
and so you got to deal with that. You have to. Well, you deal with that in one of the. If it's leveraged, there's one set of answers. If it's not leveraged, there's a different set of answers in terms of mechanically what you can do. But essentially the three cash flows that can be associated with holding a piece of real estate is you get the rent, you do something with borrowing the equity, or you sell it. So back to this idea of if all of your money was in real estate, well, that's probably not a good idea. Just like all your money in the stock market is not a good idea. But if you've got 4 or 5 or 6 asset class level allocations that make up your portfolio, and one of those is real estate, and within real estate you've got at least 2 or 3 properties or maybe more, or we didn't talk about going the pooled route, but I mean that's basically what a REIT is, and there's various legal ways to do that. Then what that means is if you have a sudden need for money, that's not the allocation you're looking for to get. You've built in liquidity, or at least the opportunity for liquidity, in one or more of your other allocations, so that you can afford to leave this one alone and make a decision in a measured manner and not have to be a pressured seller. But if you do that, and it doesn't matter what that asset is, if it's something you need to hold on to for a while, either because it's not liquid by its nature or because it is liquid but it's depressed, as long as you can work the other parts of the equation to get your money, you're fine. Anyway.
and not to put a too fine a point on it, but you sent me something, I don't know, maybe a year or two ago about this, and I looked at the 10-year projection. I was like, wow, these returns are really good.
Right.
And I was amazed how high the returns were. So one takeaway is that, like anything, the sooner, if one was to go on this road, the sooner you do it, or the more runway you have, it sounds stupid, but
Yeah.
the more runway you have, the
Right.
better the numbers look.
Yeah. Well, and what you were talking about was the thing that I sent you was basically a progression where you had rental income almost immediately, but instead of taking it for income, you were using it to add to your unit count over the course of time. So that what started out as 5 rental houses ends up at 8 rental houses before you actually get to retirement and need to start taking the income. And now, we got all kinds of things going on in terms of if you you can make the argument that it is not fair to do the rate of return calculation just on the dollars you dropped into the top, because the dollars that you could have gotten out for the rental income, they were yours. I mean, they're additions to capital. But if you go back in and analyze it just in terms of, it's also fair to look at that kind of as the house money.
You can just call it an IRR, right?
Yeah, you can do, that ends up getting complicated too. But the point is, if you look at the initial dollars that you start in with versus where it gets to 5, 6, 7 years out of the progression, then you're going to have a very hard time finding something else that can do that. And the final point that I would make is this, and this kind of goes back to something you were saying earlier when you talked about, something happens and you get a 30% loss or drawdown or whatever, and you don't want to be in a situation where that happens. One of the things that I don't hear being talked about very often is that different assets have different loss profiles. And what I mean by that is, if you ask the question, I don't want to ask the question, is it possible that this could lose all its value? But I'll ask the question, is it likely this could lose all of its value? That answer is different for different assets. If it's Lehman Brothers stock, can it lose all of its value? Apparently. Pretty good evidence. If the question is, can the entire financial sector lose all of its money? No. Okay, so in the meltdown, did Lehman Brothers stock go down? Yeah. Did the financial sector as a whole go down? Yeah, but the loss profile for the two was different because the things that would have to happen for the entire U.S. financial sector to go to zero, and that's what we're really talking about. It's not can you lose some money, it's can you lose all your money. The things that would have to happen for the entire U.S. financial sector to go to zero, we wouldn't be talking about investments anyway. We would be fighting over who gets to eat the last squirrel.
Well, you'd be teaching me your knife throwing technique.
Yeah, you know, we'd be sharpening our knives and looking at each other's pets as tomorrow night's dinner. You know, so short of a zombie apocalypse, short of an asteroid, the U.S. financial sector is not going to zero.
I'd make the point that a loss in any one sector of 80%, though, that happens.
It could happen, but it can come back. Lehman Brothers can't come back.
A whole sector.
If I owned a sector fund,
could
I lose all my money?
I completely agree. So we're talking
that's
about
what I'm getting at.
Degrees of diversification. So any one stock, unless it's Berkshire Hathaway, can go to zero. Well, any one sector cannot go to zero, but any one sector can go down 80, 90% and take a long time.
And that's as good as zero for practical matters.
For practical purposes, that's as good as zero. So, all right, so what about any one national stock market? What about the S&P or the Nikkei or the FTSE in London, right?
Right.
Okay, that's a greater degree of diversification. Well, what if you do the S&P, the Nikkei, and the FTSE? Okay, even greater.
Right.
And then you add in other asset classes, and then you're talking about an impossibility of a zero.
No, yeah, and where I was headed with that is if you look at a house on that scale, can a house lose money? Absolutely. Yeah. If you leverage it, can you have even more problems? Yes. But the likelihood that a 3-2 out in the suburbs is ever going to be worthless, that's a hard one to see.
Happened in Detroit.
Yeah,
it happened.
Yeah, it can happen. Or
Newark, New Jersey. Yeah. My family owned a house in Newark up until mid-1960s, and I don't know what it was worth in 1982, but a lot less than inflation-adjusted dollars.
It has certainly happened some places, and one of the things that is part of the analysis anytime. When I go into a neighborhood to look for houses, I want to know how many houses are for sale. I want to know how many look vacant. I want to look like, the old Mark Twain quote, buy land, they're not making any more of it. That implies that land has some inherent value. I don't think it does.
No, land, the long-term return on